This is the FRM Part 2 audio course. We are in the operational risk section, and this audio section is going to talk about key issues in operational risk modeling. So for the exam you have to understand loss distribution approach. Loss distribution approach models losses with respect to both frequency and severity with the goal of determining appropriate level of capital. The approach requires a variety of assumptions concerning the distribution of frequency and severity, most noticeably that they should be modeled separately. So the severity and the frequency should be modeled separately. The analysis should incorporate both data from the institution being analyzed and data from external sources. Various assumptions are required here, like distribution, parameters, correlation. Now ultimately the assumption of the model should be tested with scenarios, stress testing and back testing. We need to make ourselves familiar with general structure of loss distribution approach model and understand the application of frequency and severity distribution when modeling losses. So loss distribution approach is going to remain our main focus here, and we are into the section of measuring operation risk. So bank's capital methodology must address unexpected loss. The regulatory capital requirement under Pillar 1 of Basel II norms now includes provision for operation risk, and this is how it was different from Basel 1. The Basel II Accord allows several approach for the quantification of operation risk and see the loss distribution approach as the natural way to meet the soundness standard for economic regulatory capital, explicitly modeling the operation risk loss distribution of bank over 1 year. So this is an approach used here that's known as LDA, and it is accepted method in Basel II Accord for determining the operation risk capital charge, that is the regulatory capital amount. However, firms can use this approach for calculating economic capital needed for unexpected operational risk losses. If we recall, the firm's economic capital is the internal estimate of firm's capital adequacy. It is typically the case that a firm's economic capital will exceed the regulatory capital requirement under Basel II norm. So, the firm's economic capital will be higher than the Basel II norms, and that's what these methods would do most of the time. Let's understand the structure of loss distribution approach. We have 4 points here, and loss distribution approach have several steps. Each step in the approach will be described by me in 4 points. The first point is organize and group loss data into a business line event type matrix that correspond to LDA model. The evolution of loss data allows us to understand how firms exposes to operation risk. So note that this loss data is backward looking. So first step is backward looking, where you organize the loss data into a matrix that's business line type or event type, so that if there's a particular amount of loss, then you have to make sure you do it business. For example, if you are doing for prime brokerage, for trading and all those sections that we studied in the operation risk, different parts of services, or whether it's an event type like high frequency loss or loss due to algorithmic trading or systematic risk, or whatever the event type that you define. So the business like includes corporate finance, retail banking, commercial banking, asset management. The event type are like fraud and system failure. The second step here is to assign every data point in the matrix an equal weight except for split losses, old losses and external losses. The third point is modeling an operation risk loss distribution in each cell of business line event type matrix using an actuarial approach. This involves deriving one distribution event frequency and one distribution for severity. So we'll have one distribution for frequency and another distribution for severity of loss, and then combining using Monte Carlo simulation. Determining the operation risk requirement for each business line by combining empirical distribution and parametric tail ops is the fourth part. So the overall operation risk is capital required for firm would combine the results in each of these cells from business line event type into a way that takes into account the loss would not be perfectly correlated and the loss would not be diversifiable. What are the challenges in this LDA approach? So there are 4 challenges here. The first challenge is that the approach requires large amount of operation data which is not available. Then the approach is backward looking. Now the data is not available at lower level of business line to produce true bottom up model. Bottom up model means you build something from down. So one is the top down, and another is the bottom up. So when you are building something from bottom up, you need to have that data from a very ground level. So lower level data is not available. And the third challenge is that only direct losses are included, not decrease in an income result of changing in operation margin. So it's quite difficult to say to define what a loss at. A decrease in margin is not a loss, or decrease in revenue is not a loss. So there, the next point is lack of robust risk sensitivity measure, and difficult to measure the dependent nature of operation risk data. So operation risk sensitivity measure is tough to measure and difficult to measure dependent nature of data. Then we have four advantages here also. The first is loss estimate are based on unique characteristic of the institution. The second example is they are based on mathematical and statistic principle which are carefully selected. The third is that model lend itself freely to what if analysis, allow distribution to compare risk reduction program. And the last is loss estimate change over time reflecting the operation risk management of the institution. So that was the challenges and the advantages of the loss distribution approach. Now let's identify issue related to external and internal operational loss data set. Since firm may not have sufficient internal loss data for modeling, the loss data approach typically requires data from external sources which include loss consortium data and operational risk data exchange association, loss data from commercial database OP Vantage, which is a subsidiary of Fitch, and data generated from specific expert. So relevant loss data processed by DB or Deutsche Bank selects and enhances, approves the loss data from sources and feeds them into a loss distribution model. So here are some steps of loss relevant loss data process, which is Deutsche Bank approach. The first is that all relevant data is included regardless of when it occurred. The second is the process only adjusts the inflation and does not scale the loss amounts, although there are some adjustment to the weights for data from external sources. The third is that for capital purposes, the gross losses after direct recoveries, that is, do not include insurance recoveries. Then the next point is external data must be mapped to current and internal divisional structure. The fifth point is operational risk capital calculation exclude boundary events such as credit risk and market risk. Then we have convert loss into foreign currency into domestic currency. Then we have make sure that process that minimize the chance of double counting between data sources. So these are the ways or the principles on how we are going to collect data, enhance data and improve the loss data. So we don't do much about inflation if the data is old, and we gross up the loss after direct recoveries, and there are some other these are some of the issues that comes into play. Now one solution here is you weight the data. So the analyst will assign equal weight to all data points. However, there are three exceptions: split loss, old loss and external data and scenario. Split loss are losses that cannot be organized into single cell in a matrix. The loss affects more than one business line. Thus, to estimate the effect of line given, the analyst assign a weight. Now, old losses should receive a lower weight. So, one method is to give full weight to losses in the past 5 years and decrease weight from 6 to 25. Then the external data sources may require scaling due to biases. Such biases include scale bias caused by a possibility that large firm would have largest losses, or truncation bias caused by the fact that banks do not collect data below a threshold. So you have to modify the data accordingly and remove this bias. So study have suggested that scale bias and truncation bias are not a concern. However, there is recommendation approach for dealing the data capture bias. Now data capture bias is caused by correlation between probability of loss being reported to the size of the loss. So the approach does not adjust the size of the loss, it increases the probability of smaller losses and decreases probability of larger losses. So that is a data capture bias loss. which is caused by a correlation between probability of loss being reported and the size of the loss. Then we have the how frequency and similarity distribution losses are obtained. So LDA model have two dimension, frequency of loss and severity of loss. Each is modeled separately. With respect to frequency, LDA model most often use Poisson distribution, negative binomial distribution or binomial distribution. So this is the frequency. If you remember, frequency of jump, frequency of loss, all the time we used Poisson's or Poisson's distribution. Now some practical practitioners suggest only using internal data because it is most relevant, and we cannot use external data because it's not complete. Also, modeling the frequency requires less data when compared to modeling the severity. When external data is in frequency calibration, the external frequency data has to be scaled up. The calibration process for frequency distribution uses a time series of internal frequency in each cell and separates frequency data into monthly buckets in order to ensure that the number of data points is sufficient for statistical analysis. The goal is to choose the appropriate distribution, Poisson, negative binomial or binomial. This is done by comparing the mean and variance applying of good fit test results such as chi-square test. The chosen distribution should be one that should fit the hypothetical distribution. Another way to determine proper distribution analyzes the interval time of losses, assuming the loss events follow a Poisson distribution. The interval times require the event follow exponential distribution and data fit to that distribution. The chi-square test assesses the quality of fit. Firms generally use the Poisson distribution over the binomial distribution to fit frequency. Now we have the severity distribution. The severity distribution are generally considered more important than frequency distribution. Some practitioners say that considerations need to be made sure, and they also believe that it is more difficult. One problem in recent internal loss data, which is 5 to 5 years, may be that we don't have the severity distribution because we don't have the calibration tails. Using external data usually requires scaling the data and combining data from several resources. Furthermore, a complete model of possible losses, the analyst extrapolate the observed losses to estimate values beyond those points. The common approach is to fit the loss into parametric distribution that allow for values. Now the goal is to get the values in the tail of the distribution. Choosing the distribution is non-trivial task which can have significant impact. Analysts have found that it may be best to separate the distribution model and tail should be modeled by extreme value theorem, which obviously add complexity. So the distribution and the model and the tail should be separated. If you remember the extreme value theory where we used to model the tail, so our main focus was on the tail part. Another practitioner consider is to recognize that analyst's ultimate goal is to determine the operation risk capital reserve, and extrapolation could lead to the inclusion of extremely severe hypothetical losses and overestimation of required capital. So we need to be careful on how we communicate the whole process, and the better idea is to consider how to communicate and get the relevant information from the managers in all the departments. Now we look at building piecewise defined distribution. So to build a model of distribution that include adequate representation in the tail, an analyst may wish to piece together distribution. This could be done by 3 steps. The first step is that for a given cell, model the distribution using internal data for that cell that is given below given threshold. So the first threshold is 10,000. Now for the same cell, model the distribution using both external and internal data that fall between the threshold 10,000 and a second threshold, say 50 million. Then model the distribution using all data, so both external and internal, which is we take all those thresholds. So we were taking those threshold of those tails. So the first was that just model using internal data and use a threshold of 10,000. Then keep a threshold of 50 million and use 10,000 to 50 million and use internal external, then use both and take out losses beyond 50 million. So for the second and third portion of distribution, analysts have to give weight to a data from internal external to model. Although setting the weights do not determine by statistical technique, there are few considerations. First, depending on internal data point, the analyst should try to weight the internal data more, since it is more relevant for the firm itself. Second, weight assigned to data in the tail composed of step 3, which was modeling the beyond the second threshold of 50 million. The analyst should also correspond the contribution of given losses. Thus, the analyst should use impact analysis to investigate the volatility caused by inclusion of data points. So, we need to build a pairwise distribution and a model of distribution that includes adequate representation in tail. So we were building a piecewise defined distribution. Now let's move to the next heading here, which is the estimating of parametric tails. So to calibrate the parametric tails, the analyst would estimate shape and scale parameter of a generalized Pareto distribution for increasing excess threshold using peaks over threshold method. So if you remember GPD, a topic of extreme value theorem, where we compared a GPD and peaks over threshold method. So to calibrate the parametric tail, the analyst would estimate the shape and the scale parameter of the generalized Pareto for increasing threshold using the peaks over distribution method. In such technique, the shape parameter are not constant, instead they decrease with an increasing threshold. So shape and scale of the GPD for increasing threshold using the peaks over threshold method. So more specifically, peak over threshold method fits a GPD to the excess of L minus mu, L1 minus mu, L2 minus mu, where L1, L2, L3 is the loss sample. So the loss sample consists of internal losses, generated scenario and external observation. The analyst would apply maximum likelihood estimation to calculate the shape and scale of the distribution. So maximum likelihood estimation, if you remembered, we also talked about using the same in MATLAB, where we tried to put a use distribution and use this to find out what kind of a distribution it is. So there are three, four things here which are used in estimating parametric tails, which is a topic of looking at the tail. So another approach is based on corresponding limits distribution as the number of GPD gets infinitely large. One benefit of this approach is that it excludes the shape parameter. Now let's look at dependencies in an LDA model. So we have to understand how operational losses are aggregated across various types using dependency modeling. We have employed model that assume that loss in cells are independent to estimated frequency and severity distribution model separately and are independent. There are several types of dependencies that can affect the probability of loss and economic capital of a bank. There are within cell dependencies, which include the dependency between the following: the occurrence of loss event, the frequency distribution, and the severity distribution, severity samples in a cell. So within a cell, dependence could occur between occurrence of loss, frequency of distribution and severity of distribution, and severity samples in a cell. It may also be possible to have between cell dependency. The statistical evidence support that assumption that frequency and severity distribution in a cell are independent and that the severity samples are independent. Furthermore, regulatory focus is on modeling dependency between the cell, that is different business line or business event. The choice in modeling these dependency are level of dependencies, that is frequency, severity or loss distribution, or we can use appropriate mathematical models. So in practice, for various reasons, the focus is furthermore narrowed to the dependency of frequency distribution. Copula can be modeled depending on frequency distribution, and for simplicity, Gaussian copulas are used. So if you remember, we talked about whenever we want to link or find out the correlation between things that are normally distributed or that already follow some distribution, and we want, like for example, tranches of CDO, which was a topic in market risk. So whenever there are tranches or cells and we cannot use normal correlation there, we use the copula method. So to take into account the uncertainty regarding the correct copula family, the correlation estimate are chosen conservatively. For example, the number of cells m, there are m frequency distribution function and each frequency distribution for a given cell. It has been found that the correlation between frequency are significant. It has been found that the correlation between the frequency are significantly only between the specific subset of cell but are still rather low. We now move to the next big heading, which is the time aggregate loss distribution. So describe the loss distribution obtained from frequency and severity distribution. So through the process of convolution, the frequency and severity can be combined into single operational loss distribution. So there is a convolution, it's often seen, and it means interlinking the frequency and severity distribution into a single operation loss distribution. Constructing the loss distribution for the entire institution is then done using Monte Carlo simulation across the loss frequency and severity data type, and we begin with each data type and then aggregate losses across all buildings. So you can think as the first step to be model frequency, model severity, then use convolution to get a distribution, then use Monte Carlo, and then start from bottom up. So these are the steps that we are going to use here. So in a few tricky terms here, but nothing new in terms of the terms except convolution, which is combining the frequency and severity distribution. So with the single operational loss distribution, we can then identify the mean annual loss and loss at a given confidence and determine the amount of economic capital required to support potential risk. Note that it is unlikely that losses are perfectly correlated. It may be unreasonable to assume no correlation. Therefore, analysis of correlation between business line event may be required. Once loss distribution that combines severity and frequency using convolution is constructed, we can examine the difference between operational war measure and expected loss and the amount of economic capital needed to cover that. So let's understand how to aggregate loss distribution corresponding economic capital. This would be looking at later. Let's look at first heading in this, aggregate loss distribution, aggregate or add loss distribution. So in insurance, the loss distribution for a risk profiling for an institution which can include the risk reduction effect of insurance, which alters the aggregate loss distribution. This is done by reducing the severity of losses that exceeds a given deducible in the insurance policy. In other words, insurance typically lowers the severity but not the frequency. Then we have determining economic capital. Economic capital is the capital that will be absorbing the unexpected loss with high degree of certainty. It's popular to use average default rate associated with the rate of institution for degree of uncertainty. In that case, the rule defines economic capital in terms of operational value at risk. For AA plus or AA plus, the rating confidence is 99.98. This linkage between rating and value at risk based on economic capital is the reason for popularity of economic capital. This standard measure for operating risk economic capital is equal to operational value at risk minus expected loss. So that becomes the unexpected loss. The practitioner often adjusts the expected loss in different cases. For example, in case of operational risk, to accommodate the existence of fat tails, the median loss might replicate the expected loss. So there might be a double counting here. Now the capital allocation techniques for business line event type cells are expected shortfall contribution, which is the average of expected loss given the loss exceeds the war level for a confidence level, which is expected loss after a given loss should be greater than war. So the average loss is also known as conditional war. Since analytical representation of such losses aggregate are not possible, practice and use simulations. An outline of Monte Carlo simulation that can produce a sample aggregate loss distribution. So we have around 3 steps here. The first step is generate loss distribution in individual cell. Generate a sample of n1 to nm of m dimensional frequency distribution specified by Gaussian copula. For each k, compute the severity distribution. Incorporate the effect of insurance, randomize the loss in the cell, apply corresponding insurance model to each loss and compute the corresponding net losses. Then the third step is compute aggregate loss distribution. So the whole idea here, if you were to understand broadly, is that there are various cells, and when you have a loss in cell, it might cause a loss in other part as well. So if you have got a missed trading or big trade loss, it says that you might have a loss in the other corporate finance division that is lending or loan or something like that. So we're trying to find the relation here. So the step should be repeated to compute a large group of loss sample. The economic capital is that computed using the following step. The economic capital is operational VAR minus the expected loss. The economic capital is then allocated to the cell of business line event type matrix. This is done using expected shortfall technique. So then we move to the economic capital of each business line is computed by summing the capital allocated to its cell with respect to specific event time. The last topic here is validation of loss distribution approaches. Now, to show that the estimates for regulatory and economic capital are reasonable, there should be a validation process. Given that confidence level are often very high, this is challenging. Data problems and lack of risk sensitivities measure for operational risk model complicate the process. Thus, there is inherently uncertainty in the validation process, and expert judgment should complement quantitative measure. The validation of an operational risk model involves review of data points, model methodology, and model output. The review of the model would include examining the assumed frequency, severity, dependence structure, and insurance, as well as assumptions in models such as correlation. The validation should include an assessment of the impact of different modeling assumption and the sensitivity of capital requirement to parametric changes. To parameter changes. So that was all regarding the operational risk capital. I'll quickly summarize some of the things here. So properties of distribution of operational loss. Here we try to model the distribution of loss amount by using full data approach, in which we feed available data with a parametric severity distribution. The alternative method is EVT. In modeling loss distribution, we have 9 common distribution, 4 of which are light tailed and 5 of them are heavy tailed. This is something that we are going to look in the next class. Heavy tail distribution are found to be a better fit. So we are looking at the loss distribution approach, and I am showing this on the screen, where the first step is weighting data points, frequency distribution, severity, parametric tails by using peaks over threshold and generalized Pareto. Frequency and severity are convoluted to get final distribution. So I think that was it for this session. I hope it added something to your current knowledge base for the FRM Part 2 exam. Thank you for listening.